Most financial decisions are driven by human emotion rather than logic. On the trading floor, rumors spark panic, and blind optimism fuels buying sprees. This creates a predictable cycle of failure. An investor watches a stock climb, gets swept up in the greed of the crowd, and buys at the absolute peak. When the price begins to fall, they sell at the bottom out of fear, locking in the loss. Conventional financial data often reinforces this trap. A standard ticker tells you the price of an asset, but it reveals nothing about how the market actually feels about that price. Since emotion moves the market, investors need a way to see it. Success requires a reliable method to graph the fear and greed of millions of participants in real time. Learning to interpret this hidden psychology is the first step towards escaping the emotional traps that define the stock market. Mapping that sentiment requires looking back 400 years to the rice exchanges of 18th century Japan. A merchant named Sokyu Honma became the most respected trader in the country. He amassed a fortune so vast that legends were written about his family's wealth. Honma realized that the price of rice wasn't dictated entirely by supply and demand. He saw that the price was heavily influenced by the psychological state of the traders. To track this sentiment, he developed a visual system. His charting method, what we now call the Japanese candlestick, provided a systemized approach to statistical behavioral analysis. This diagram shows a standard Western bar chart next to a Japanese candlestick. While they represent the exact same data points, the candlestick is designed to be more communicative. The structure is simple. You take the opening and closing prices of a session and box them together to create the candlestick's body. The color of the body reveals who won the struggle. A white body means the price closed higher than it opened, while a black body means the sellers drove the price down. Thin lines, called shadows, extend above and below the body. These map the extreme high and low prices reached during that day. This anatomy matters because the physical shape and color of a single candle summarize the day's emotional struggle between fear and greed. When viewed in sequence, these individual candles form recurring patterns that signal a shift in market momentum. In this descending series of dark candles, a doji suddenly appears. This cross-like shape shows that the open and close were almost identical, providing visual evidence that the selling pressure has stalled. These formations act as a frontline illustration of a larger conflict. Every session is a documented battle between the bulls and the bears. Recognizing these psychological reversal patterns allows an investor to anticipate trend changes before the general public reacts to the news. These centuries-old charting techniques now integrate with the massive speed of modern global markets. Modern software can scan thousands of equities simultaneously, searching for the exact same psychological patterns Honma identified in the rice markets. This gives the investor a measurable advantage. They can pinpoint high-probability trade setups across entire sectors in a few minutes. Combining behavioral tracking with computing power allows an investor to filter through market noise and identify historical setups where the odds of a reversal are statistically in their favor. The candlestick system works by replacing subjective impulses with a visual framework that exposes the market's collective psychology. The visual evidence of a signal provides specific markers to buy and clear stop-loss levels to sell, allowing an investor to execute trades based on probabilities rather than hope. Success follows the ancient Japanese maxim, consult the market about the market. The only truth in investing is what the collective sentiment reveals right on the chart.